Welcome, ladies and gentlemen, Commodity TV for you here in Zurich today. And we just met Sandeep Singh, the CEO of Osisko Gold Royalties, on a roadshow here in Switzerland. And of course, we want to get a short update from him. Sandeep, hi, how are you?
Hi, Jochen, I'm very well.
How are you? Great to see you again. Perfect. Thank you very much. All fine. So I was just listening to two of your presentations. I really liked what I heard, so I want to buy some stock, that's for sure.
Good. That's the job done then.
Yeah, exactly. No, but really, I must say, it looks to me like a very conservative, real high quality investment, I must say. And I mean, we must not explain to the audience what is a royalty, what is a stream. But what I really like with you guys is you have a growth plan, you are paying quarterly dividends, and you have no net debt. So the first quarter was a little bit slower, but I think the second quarter was already fantastic. It was a new record.
Yep.
And I think you want to produce 90, or you want to receive 90,000 to 95,000 gold equivalent ounces. So what's the game plan for the second half?
Yeah, look, I think you touched on a lot of it. I mean, at the end of the day, as a gold royalty company, we think we are the right investment for an inflationary world. One, because the commodity is gold. Second, because we don't get impacted by inflation the way our mining partners do. So this is really when we shine in the type of backdrop that we're in. And an example of that is, yes, Q2 was a record for us. We had the most amount of ounces delivered to us in our history by our partners, which is important. That derived record cash margins, so we don't get squeezed on the margin side as some of our partners do, unfortunately. And it's also good news because the second half of the year should be stronger. We have guided to 90 to 95,000 ounces of gold equivalent. In the first half of the year, we got 40 from our partners. And the reason for that is not just optimism. We've got two of our core assets that are strengthening in the second half of the year, one being Eagle, which is still ramping up. And obviously the second half of the year is always going to be, will be stronger for them because it's in the winter months, they don't process for 3 months of the year. So second half is naturally stronger. And then the other is Mantos from Capstone, where they're ramping up an expansion. And they've said Q3 is when they expect to get steady state. So two core assets will be stronger in the second half of the year. That bodes really well for us as we finish 2022.
Super. So you're still fine with the guidance of 90 to 95,000 ounces?
Yeah, absolutely. I mean, we would have changed it if we weren't. That being said, maybe on the lower side, and that's just normal. We've already kind of explained that with the first half of the year. I think it's fair to say that our partners, not just ours, but the mining sector in total, was dealing with Omicron. When you have a large labor force in a mining operation and you have to quarantine people every 2 weeks because somebody has an outbreak, that's not a recipe for maximum ounces. But the beauty is those ounces don't go anywhere for us. They get pushed from one quarter to the next, and we don't have the fixed cost impact. So yeah, still within our guidance and still hopefully having a record second half of the year.
Okay, super. You said it already, you are not impacted directly by inflation, but let's put it that way. I would say you are maybe a little bit indirectly, you might be impacted on the finishing of the development of some bigger projects for the next year. So do you feel already that there are maybe some delays on the larger projects? What are the larger projects you see within the next 2-3 years going into production as you want to grow the business massively?
You know, I don't think we are. Obviously, it's a big portfolio. There's always things going forward and backwards, but generally things are moving forward for us quite nicely. To be honest, inflation does more good for us than bad. You know, it helps the commodity eventually, not so far this year with a strong US dollar, but it helps the commodity. It gives us more opportunities to deploy capital. When there's more CapEx required to build things, obviously we are looking to fund people in that space. It gives us more opportunities to do it. And thankfully, you know, the worry is always, you know, does the market change and are your assets less important to the operators? And the answer to that is by and large, no. Our assets are core to the companies that operate them. They're working hard to expand them. A number of cases, Mantos is being expanded now. They're already talking about the next expansion. They're not done the first one. Eagle is ramping up. They're looking for more ounces at the same time and finding them. Whether it's Island, Lamaque, CB, all three are in Canada and in the process of expanding their operations and investing significant cash flow into them. So no, the short answer is no. Our assets are moving in as straight a line as you get in the mining space. Sometimes obviously there are delays, but we're very happy with the growth in the pipeline.
Fantastic. I saw in your presentation also that all the companies you are partnering with, I would call it like that, they have drilled like 1.4 million meters last year. I mean, that is crazy.
It is crazy. And before that, for the 4 years prior, they drilled on average 1 million meters. So Depending on what you want to use on a per meter assumption, I tend to use $350 a meter all in. I think that's a low number in the world we're living in now. But that's, circa $500 million of work last year that our partners did on assets that we have royalties and streams on that we didn't have to contribute anything to. It's a massive amount of work. And more important than the work is the outcome. They found a lot more ounces than they pulled out of the ground. So that speaks to the sustainability of this business. And it's really upside that we're seeing now for the first time in our history. When you remember, we only started out with one producing asset in 2014. We've built a decent, an incredible pipeline since then. Now we have 20 producing assets within a basket of 165, so a lot of diversification. And now the investments we did 2, 3, 4 years ago are getting more interesting as there's time that's passed and more money has been spent on them. Our partners are finding the ounces, not of today, not of the next 10 to 15 years, but they're finding the ounces that'll be coming out for us hopefully in the years after that. So that's really how the royalty model works best. Once it starts to gather momentum, it tends to build on it. And we're seeing that, from our largest assets at Canadian Malartic, where the Agnico and Yamana have invested in, or are investing in building out the underground, to all of our smaller assets seeing similar types of intensity.
Okay, super. Some of our viewers wanted to know, how does it work with mine life? Meaning your life of receiving royalties. Obviously, a royalty is forever normally on a mine. But if you look at your portfolio, what would you say, if you do a little bit of an average of your mine life from the projects, what would it be like, 15, 20 years?
Yeah, that's about right. So when we look at our life of mine on a weighted average basis, so not not direct arithmetic average, because that would be biased, but on the assets that matters, what is our life of mine? And we calculate that. Obviously, we have certain assumptions in terms of a little bit of extra growth, but we calculate that as being on at least 15 years. In some cases, it's up to 20. So for gold assets in particular, that is long life.
Absolutely.
And that the important part is it's not ending. As I said, in a year like 2021, when we had that much drilling, 1.4 million meters, the reserves were replaced. Sorry, the mining was replaced by reserves. If you add the M&I and the inferred, it was replaced by multiples. So things continue to grow. They're not getting shorter in life. They're only getting longer in life.
Okay, super. If we look at your balance sheet, what I have found in your presentation also is like you have, on the one hand, over $300 million in cash, which is extremely healthy. You have a $300 million convertible bond, which is due at the end of the year, that we will talk about shortly in a second. But also I saw you have investments from your former, let's call it accelerating model, which is valued today 400 million around. So I think there is a lot of upside in the future with, let's say, gold rising to 2,200, hopefully 2,500. I think we are in the environment for this, really.
Could certainly be.
So how do you rate your, let's say, net debt free? Yeah, you have a firing power, I think it was 650 million credit line. So from that perspective, what would you do in the future with your investments if they perform extremely well? Because to me, it looks like you have like a 500 million plus, let's say, quiet reserve, I would call it, when markets move, on the one hand. And on the other hand, when you pay back the convertible at the year end, that would absorb maybe all your cash. So how does that work?
Yeah, so there's a lot there, but you got the crux of it. So yes, north of $300 million in cash, Canadian, these numbers, $300 million convert in Canadian again at the end of the year that we will pay off. We want to live life without that convertible debenture. We're making cash flow in the meantime. We do have something between 400 and 500 million of equity investments. The intent is not to keep those forever. We will look to reduce and reapply that towards royalty growth. And then we have a $650 million Canadian credit facility that's the cheapest debt in the sector, and it's completely undrawn. So going forward, we'll build cash. We'll use our credit facility for new growth if we see it as being good value. And if not, there's periods of times when royalties are too expensive. We're happy to take excess cash flow that we're making and apply it to our dividend, apply it to our buyback, which we were active on in July and August, and we'll continue to be active. Because unfortunately, our strongest ever quarter, I should say, in Q2, leading into hopefully our strongest ever second half, has also coincided with our cheapest share price historically, minus some little blips along the way for short periods of time. So that's just market momentum. Right now it's been against gold. I think ultimately the US dollar will weaken and gold will be the beneficiary of it. But our balance sheet is exceptionally strong. We have all the firepower we need to continue to grow our business, but we're going to be selective in how we do that.
Absolutely. And yeah, last but not least, I saw all the analysts with their targets. And I think, if I'm correct, the average target is like 22, 23 Canadian dollars, and your stock price is below 14. So 13 something, I think it was yesterday. That's like a $10 gap. So why are the analysts much more positive than the market?
Well,
yes, it's not because you pay them.
No. It's 12. That's a 12-year target, and I think it could be conservative. To be honest, I mean, look, that's a long way to go. You're right. Right now, we're below $13 as we're taping this. I think the average was 21.50, maybe it was 22. But they're all bullish on it because of the asset quality. I mean, when you look at the replacement value of our business, it's exceptionally high. When you look at what people in our peer group are paying for assets right now, you can easily justify that doubling based on the assets we already have, let alone the new development assets that are coming on in the coming years. So it's just a matter of time. We've been a good performing royalty company. We've been right at the top end for the last 2 years in a down market. Outperforming is not as much fun in a down market as an up market, but I think our time will come. And really, the company has never been in stronger shape than it is right now.
Super. That was a great final sentence. Thank you very much, Sandeep. Wish you all the best. Stay healthy. That's the most important thing these days. And please raise the dividend because shareholders love that.
Appreciate that. And we'll find the right time to do that. And it's just good to be doing this stuff in person again after a 2.5-year hiatus. So thank you for your time.
That's right. Thank you very much.
Okay.
Yeah, ladies and gentlemen, that was Sandeep Singh, the CEO of Osisko Gold Royalties. And you heard it, the company is in fantastic shape, despite the share price suffered from the markets, which is quite normal. A lot of companies are, let's call it, underwater with their share price. But, there is exactly where the opportunity lies in, because of course you want to buy cheap, not high. And this is exactly one thing which is really speaking for the company, but the high quality of the projects, the big pipeline they have, the big portfolio, and honestly, the growth path they are on. And don't forget about the quarterly dividend. So those are all the reasons we like. And we highly urge you to have a look at Osisko Gold Royalties. Thanks for watching us. And for today, bye-bye from Zurich.